How to manage tax liabilities. Now that we've looked at investments as an approach to harnessing income over short and long periods of time, let's discuss how you can manage tax liabilities to make the most of your money. Simply put, tax liability is the amount of money that an individual or business owes to the government in taxes. Now, while tax liability may mean the same thing for every individual, corporation, or entity, the amount payable to tax authorities can be vastly different. The amount owed varies by each entity because of the different tax laws that are currently in operation. As such, it's difficult to give a precise indication of what tax you might be liable for in your particular situation. As a matter of fact, the tax liability of a company is not the same as that of individuals with wages or salaries, as an individual might pay taxes on particular or multiple sources of income, while a business is required to contribute tax payments on every product that is sold. Ultimately, tax liabilities are determined by calculating taxable income, or the value of taxable goods or services, and applying the relevant tax rates and deductions. There are quite a few types of tax, and the most common include income tax, which is a tax imposed by the government on the income earned by individuals and businesses. In most countries, people who are higher earners typically pay a higher percentage of their income in taxes. Sales tax is a consumption tax, meaning that it is designed to be paid by the end consumer of the product or service. This is why you'll normally not notice it, but see it added to the sale of goods and services at the point when you purchase. Finally, there is property tax. This is a tax that is imposed on the value of real estate, including land, buildings, and any improvements made to the property. The tax is based on the assessed value of the property, which is determined by the government. It is typically calculated as a percentage of that value. The best way to manage your money when it comes to tax liabilities is to ensure that you accurately calculate your tax contributions and pay them on time, because if you don't, there are normally penalties and interest charges. So by knowing your taxes and doing the work in a timely manner, you can ensure that you don't pick up needless penalties that could have otherwise been easily avoided. When it comes to making those calculations, there are a number of approaches you can take to limit your exposure to tax and ensure that you don't overpay. These are called tax expenditures. There are 6 main areas to think about here, and they include credit, whereby some credits reduce your tax liability dollar by dollar, like the child credit. Deductions, where you can deduct expenses you incur from your taxable gross income. Mortgage interest paid for an owner's occupied home is a prime example of this. Deferral, whereby you can delay some deductions and attribute them to future years. This works in the case of delaying interest earned on bonds until they are redeemed. Exclusion is the 4th area to think about, which is where you are able to exclude income that would otherwise constitute part of your gross income. This includes things like employer contributions to medical insurance. Exemption, whereby your gross income is reduced because of your status or circumstances. And finally, preferential tax rates, where you can actually have a reduced tax rate on some forms of income. For example, capital gains on certain income can be subject to lower tax rates under the individual income tax. Overall, understanding your tax liability is important to being more financially savvy. Knowing the tax you've paid and owe is really important when it comes to being more financially literate. So take the time to understand them and become knowledgeable. Think about the taxes you pay and how this impacts your monthly and annual income. See if there are better ways of doing things. Ultimately, tax can be quite complicated, so seeking professional advice is always a smart move.